Hello traders, this tutorial explains Wyckoff's theory on the market. The Wyckoff theory is an advanced concept, and as such this tutorial will be most beneficial to the more experienced traders. Regardless, even if you are less experienced, you will definitely benefit from this tutorial, but you will need to go over it a few times before you will be able to digest it completely. This tutorial is long and heavy, long in duration and heavy with Wyckoff's concepts, which are not always easy to understand. For this reason, I provided timestamps. Don't try to finish it all in one go. Instead, take the time to digest the materials and watch each section a few times. I also provided a PDF tutorial. If you find reading to be easier, then by all means download the PDF. It is just as good, if not better, than the video. Like in the previous tutorials, allow me to remind you of the contract. My role is to provide the content and to explain it to the best of my ability. Your role is to ask questions and not take anything I say for granted. I am looking forward to your questions and comments. I would like to explain the reason I decided to prepare this tutorial. The reason is that I came across an X post describing Bitcoin's move above the range, meaning above 49K, as an uptrust after distribution in phase E of a Wyckoff distribution schematic. After you will go through this tutorial, you will understand that what this gentleman wrote was a mistake. Actually, two mistakes. First, he interpreted what is a reaccumulation pattern as a distribution pattern. His second mistake is that a phase E in any Wyckoff schematic means that the price is trading below or above the range. So if this is a phase E, price should be below 40K. When price is trading above the range, maybe we are in a phase E, the exit out of an accumulation range into higher prices. I don't care that this gentleman made a mistake. What bothers me is that an individual with a large following is misleading his audience, even if it is not intentional and causing them harm. As an analyst, you need to do two things if you don't want to harm the people listening to your assessments. First is that you always have to provide two options, because you don't know what is going to happen. Second is always be low key. Say, in my opinion, I think, okay? Because all you are doing is sharing an opinion. Trading is not mathematics, okay? 2 plus 2 doesn't always equal 4 in trading. For this reason, I've decided to dedicate this tutorial to the Wyckoff theory, and may God bless our endeavors and help us to always find the right direction. Who was Richard Wyckoff? I don't intend to go over Wyckoff's biography. The important thing to know is that Richard Wyckoff was involved in the stock market since he was 15 years of age. He became an independent broker at 25, and he had an engaging personality, and he gained the trusts of many large operators that were operating at the time at the stock market. And he discovered that the best indicator of a security's future price was the relationship between supply and demand. Wyckoff believed that analysts needed to determine the relative power of buying and selling waves to predict the intent of the dominant forces behind a market move. Wyckoff came out with the concept of the Composite Man. Today we don't use the term the Composite Man, we use the term whale or whales. However, the Composite Man, it's not necessarily one entity. The Composite Man comprises many large groups that affect the marketplace and cause the market to act and react. The market responds to the natural law of supply and demand, but the Composite Man is the primary force behind the scenes. According to Wyckoff, all market action is manufactured operation, meaning that an asset is not inherently bullish or bearish, and the buying and selling are centered and come from interests of the better informed traders. We call the institutional players, we call them informed traders, and retail is generally described as uninformed or untrained. Wyckoff also came up with the three fundamental laws that govern not only the stock market, every trading platform. These laws are the law of supply and demand, the law of cause and effect, and the law of effort versus result. The law of supply and demand determines the price direction. When demand is more significant than supply, prices will rise, and prices will fall when the supply is greater than the demand. The law of cause and effect, I want to explain it simply. In the Wyckoff methodology, a cause is a range, meaning when price is in an accumulation range, the market maker is building a cause to increase the price later after it trades out of the accumulation range. And when an asset is in distribution mode, the market maker is building a cause to later dump the price. The longer the accumulation or distribution range lasts, the more significant the following move will be, and I will show it to you on the charts. The third law is the law of effort versus result. What it means is that the market maker will always take the price through the path of least resistance, meaning that as long as the supply exists, a floating supply, not under the Composite Man control, he will take the price lower and lower until all the floating supply is over and done with. And when the demand for a certain security is strong, then prices will naturally move up. This is the law of effort versus result. Go over your PDFs. I explained it more extensively, but I think that it's enough. I think that I made my point clear. Now, by now, you should already be familiar with market structure. We have three primary market structure patterns: an uptrend, a downtrend, and a sideways trend. In the Wyckoff methodology, the sideways trend is paramount because this is where the market maker or the whale or the Composite Man, this is where he is doing his job. What is his job? Either to accumulate, to take over the supply, or to distribute his supply to later dump the price down. In a range, you know, if an asset is in a range, you know that the market maker is building a cause. We have two main patterns in Wyckoff methodology. The first is accumulation. In the accumulation phase, professional traders purchase all the available stock present in the market. This phase of the trend focuses on the easiest path. What is the easiest path in an accumulation range? To lower the prices, and during this accumulation range, the market maker will test the balance of supply and demand. What will he do? He will pump the price up to see in what level exactly does the supply become stronger than the demand. And when he reaches this level, he will push the price down in an effort to get the uninformed traders, or the weak hands as they are called in Wyckoff theory, to sell their asset. And in this way, especially if it lasts a long time, the uninformed traders, or the weak hands as they are called, will give up hope of price ever trading above this range, and they will get rid of their stock, and the Composite Man will buy this asset from them, take over the supply, and later, after everyone has given up, he will begin to mark up the price. A distribution phase is the opposite of an accumulation, because during the uptrend, buyers tend to be more aggressive than sellers, and that is because large quantities of people get into the market, and usually the public is less informed, more emotional, and puts pressure on the price and causing it to rise further. The upward movement will continue until the buyers and sellers conclude that the price has reached its fair value. The buyers will then close their long positions, while the sellers start taking short positions. When we are talking about the buyers and sellers here, we usually don't refer to the general public. We refer to the whales, to the large operators, because these large operators took over the supply while it was in an accumulation. They marked the price up. After they have finished marking the price up, when they see initial signs of trend exhaustion, they get rid of their supply, closing their long positions and taking short positions to ride this stock or other security, to ride it down until it enters an accumulation range again. The anatomy of an accumulation range. And I will explain. Every accumulation range has a structure. This structure includes key points within the structure. It is possible that some points will be missing, but not these key points, and I will explain the key points. First is the selling climax, automatic rally, upthrust, secondary test, and the jump across the creek, or a sign of strength. Now I will explain each key point in simple words, and you will refer to your PDFs for more extensive explanations. Now assume that we are in a downtrend. In a downtrend, price begins to accelerate to the downside until it reaches a certain support level which traders find attractive, and at this stage the momentum to the downside is arrested. Why? Because price has found support. After the support, price begins to go up, and traders become hopeful until they realize that it was a dead cat bounce. Once the traders realize that this was a dead cat bounce, everybody wants to get out of the market, and heavy selling action begins, and this heavy selling action is reaching a peak or a climax at a certain level. At this level, the selling climax, price finds support and the buyers are exhausted. What happens after that? because the buyers are exhausted, price begins to go up. Once price begins to go up, the late shorters also begin to cover their position and they become forced buyers, and price goes up and up and up until it reaches resistance, and that's the extent of the automatic rally. Congratulations, we have a range low, we have a range high, and the accumulation range can begin. After the automatic rally, price of course is going down. Why? Because not everyone got exactly at the range low and not everyone sold exactly at the range high. So once everyone realizes that price is not going above a certain level, traders will be quick to get rid of the stock, and it makes what we call a secondary test. A secondary test doesn't necessarily have to test the range low again, but many times it does. And the process repeats itself. Why? Because when we are at the low levels, everyone knows that it's support. They begin to buy and buy and buy until they reach the range high. And at the range high, you have the breakout traders. What are the breakout? The breakout traders are a special breed of people. They are very brave and sometimes very stupid because they buy the breakout, the market maker initiates heavy selling, or at this stage it doesn't necessarily have to be the market maker, because at this stage everyone knows that this stock or crypto is a loser and they get rid of it. And we begin to have a range, a structured formed range with a range low and a range high, and price is ranging. Now, once the market maker has judged that he has taken over enough of the supply, he will begin to test the supply and demand. What will he do? He will manufacture an event that will cause price to go below the range low. Why? Because he wants to see if there are any sellers left at these levels. And if there are sellers, of course that price will continue to go down and this spring event will fail. But if he has taken over enough of the supply, and he will take over some more supply here at very good prices, and now there are no sellers left on the market. Everyone who was a seller already sold, and we begin to have a trend, an upwards trend. And once price gets above the range high in a sign of strength event or a jump across the creek, and the retest, the markup phase begins and the accumulation is over. Now there are a few phases during an accumulation phase. I will just go over them briefly, and again I refer you to the PDF because the PDF is more extensive, but I don't want to tire you too much. Phase A is the stop of the previous trend. Where is phase A? First, phase A begins at the preliminary support and ends with the selling climax. After that, we have an automatic rally. It is still considered the phase A. Why? Because to build a cause, we need a range low and a range high. Phase B is the construction of the cause. A construction of the cause is a fancy Wyckoff name for a sideways range. In phase C, the market maker initiates a test. What does he test? He tests to see if he can take over all of the supply, or maybe if he pushes the price lower, there will be more sellers. And this is the spring action. You will not always have spring action. Okay, it's remember it because it's very important. I don't want you to be to trade in a future bear market and you will wait for a spring and you will not get it, because you will not often get a spring action. So be careful with that. Okay, after that, phase D is a trend within the range, a move from the spring to the range low, from the range low to the range high, from the range high a retest, and a phase E is a trend outside the range. This is the markup phase. Okay, now a distribution is the concepts, the key points, everything is pretty much the same. We have slight changes in terminology, okay? Because a distribution phase is at the market top, not at the market bottom, but the structure is very much the same. What happens? What do we have here? Instead of a last point of support, we have what it's called preliminary supply, PSY. Okay, what is a preliminary supply? It is an elevated price level, and in this price level some traders say, okay, it's enough, I've made my profits, the market is overheated and I'm selling, and price begins to push down. However, we are still in a bull market, and once price pushes down, the buyers become interested and they step in and they push the price up and up and up until it reaches a buying climax. A buying climax is at such an elevated price level that all the traders that are involved in the market begin to sell. Or maybe not all the traders, because you can usually rely on the uninformed traders, on the general public, to believe that price still has some more room to the upside, and this is where they are left holding the bag. After the buying climax, we have an automatic reaction, AR. Okay, what is an automatic reaction? Price drops to a level that in this level there is some interest among traders. They still believe that this is relatively cheap, and they begin to buy, and price moves up and up to form a secondary test. What does the secondary test? What does it test? It tests if the supply is stronger, if the supply at the buying climax at the range high is still strong. And usually it is, and we begin to trade in a sideways range. During the sideways range, what the market maker will do is he will entice the breakout traders to buy above the range high. Why? Because they trade breakouts, excuse me. They are breakout traders. So what will they do? They say, we have a range breakout, let's go. And they buy the breakout, and the market maker initiates heavy selling and price goes down again. Another breakout, usually higher than the first, and it could be 1 time, 2 times, 3 times. It doesn't matter, until price reaches a level that the market maker knows that that's it, it's finished. The buyers are completely exhausted, and this is where he will initiate a heavy selling activity, which will take price below the range in a sign of weakness. After the sign of weakness, some traders will still have hope of a bounce, and they will test the range low as resistance in a last point of supply, LPSY, last point of supply. This is where the majority of the traders, the professional traders, will sell, and price will leave the distribution range for a long time and we have initiated the downtrend. This is a distribution range. And we have the same phases again. Phase A arrests the trend. Phase B is a sideways range. We build the cause. Phase C is a spring, but it's not a spring. We don't call this action a spring because it's distribution. We call it upthrust after distribution, UTAD. This is a spring, but it initiates the downtrend. Following that, we have a sign of weakness. What is the weakness? The weakness is that the range low doesn't hold as support. A last point of supply. What happens? The heavy selling at the range low, and the range low flips to resistance, and we have a trade below the range in phase E of a distribution schematic. Congratulations, now you know accumulation and distribution. Life will never be the same again. Now we are talking about structure, and this is so important. Not every Wyckoff book or Wyckoff trader mentions this. We are used to think, I said in the previous tutorial that we are linear thinkers. And when we are thinking about distribution or accumulation, we think of a horizontal range. But the truth is that, and I will show you in the practical charting, that not every accumulation or distribution is horizontal. And what you need to do is you need to look for downward sloping channels or upward sloping channels. You need to look at bottom formations such as a descending wedge or a double bottom to assess if it is a Wyckoff accumulation or Wyckoff, and the other side, a Wyckoff distribution pattern, okay? Because it will not always be that easy. It is very probable that a distribution range will look like, at least at the beginning, like an ascending wedge, and you will see a lot of descending wedges and downward sloping angles in an accumulation range. You need to be flexible with your mind, and all it takes is a little bit of practice. Once you are practiced, you will see it in seconds, I promise you, so don't give up hope. Okay, guys, this is extremely important, so pay attention. If you are tired, come back another day. This is extremely, extremely important. Pay attention, okay? Now, Wyckoff's theory offers the trader a dichotomy, okay? At its most basic form, we have the market phases are structured and they're easy to follow. We have distribution at the top, followed by a markdown phase and an accumulation at the bottom. The reality is more nuanced. At its most basic form, a bull campaign, and I chose the word campaign, okay, will include an accumulation phase at the bottom, followed by several, not one, several reaccumulation periods before a final top and a distribution range that ends the bull market. It is sometimes very difficult to differentiate. You do not know if this is just one big reaccumulation phase or are we at the end of the bear market. Pay attention, guys, this is important. Because a bull campaign can take a year, okay? And bear markets are even longer than a year. And a bear campaign can take several years, and you can expect several redistribution phases before the final accumulation and mark up during this bear campaign. Guys, this makes everything a lot more difficult, and you need to have experience to recognize, are we in an accumulation phase or are we in a distribution phase? And it's not easy. I chose this image because this image was a trading view idea. Of course that I do not show the trader's name because I want to respect everyone. It was, look here, March 15, 2022. What did this trader see? An accumulation range, followed by, what did he expect? A breakout above the accumulation range and a markup phase. However, the reality of the situation was that this was the first redistribution event. It was the first bear market rally between January and March of 2023. Okay? And it's a problem. It's a problem for the trader because if you don't know where you are in the market phase, in the business cycle, and you accidentally identify a distribution as accumulation, you are on the wrong side of the market. Okay, guys, one more time, pay attention. It's important, okay? Well, what can you do? You say, okay, you taught crypto. You go figure it out. I will, and I have. And there are 3 or 4 guidelines that I can give you. The first guideline is context. When you decide if a chart pattern in front of you is accumulation or distribution, ask yourself, where are we in the business cycle? For example, the Bitcoin 4-year cycle gives us a rough outline. We know that we can expect at least 1 year of a bear market, 2 years of accumulation, and 1 year of a bull market. Roughly, okay? So if the beginning, the formal beginning of the bear market was in November 2021, you must understand that if you are in March, 3 or 4 months after the initiation of the bear market, this cannot be an accumulation range. It has to be redistribution. How? Why? Context. Context is important. Second is time. What do I mean by time? Bull campaigns are short and bear campaigns are long. If a bull market lasts a year, you should be on the lookout for distribution, okay? If it lasts 2 years, all the better, because bull campaigns are short, but bear campaigns are long. So in a bear campaign, don't hold your hopes up every time you see a range, okay? Because you will most probably have 2 or 3 redistribution ranges before the final accumulation. So you need to understand that bear markets are long and bull markets are short. The third point is psychology, the psychological perspective. And this is a point you have to understand. It's important, guys. Bear markets are mind-numbingly boring. If price action is quick, if price action excites you, if you still have a spark of hope in your heart that price is going to go up, the accumulation phase is not over and done with. Okay? Because the bear market will destroy a trader's soul. This is important. If you are excited, if you are hopeful, and we are in a bear market, give it up. It's redistribution. And the fourth point is that we don't always have to know if it's redistribution or if it's an accumulation. Guys, we are traders. We trade the chart. We have support. We long the support. We have resistance. We long the resistance. Yes, we don't always long the support and we don't always short the resistance. But if you follow the basic trading practices, then you will most likely be on the right side of the market. This trader here, he failed to recognize that this is a redistribution, but he was on the right side of the market. I didn't show the whole trade because I don't want to expose his name, but he was short here or here, I don't remember. He was short, so he was on the right side of the market, and most probably he was able to trade the continuation to the downside. So you don't always need to know. We are traders. We don't need to know 20 steps ahead. The 2 or 3 steps ahead sometimes is enough for us. Okay? Now, the Wyckoff method of buying and selling securities. This is important. It's less relevant right now because we are in the midst of a bull market, and now is not the time to select your altcoins or to determine the balance of your portfolio, how much Bitcoin, how much Ethereum, but it will become extremely important. Guys, pay attention, please. It will become extremely important close to the end of the bull market. Why? Because as traders, our job is not finished once the bull market is over and done with. We are still in the market. This is our job. This is our profession. And we need to trade the bear market. How will we trade the bear market? We will need to choose assets that underperformed during the bull market, and we will need to short these underperforming assets, and we will ride them down until the bear market will be over and done with. So the Wyckoff method of buying and selling is extremely important, and I will go over everything, okay? First, you need to determine the present position and the probable future trend of the market. Why? Because you need to know if we are in a bull market, you are a buyer, you long; in a bear market, you short. Then you need to select assets in harmony with the trade. And it is important because in every bear market, there is 1 or 2 coins that they're bullish. Yes, we are in a bull market, but these assets are bullish. So what will you do? Will you short the bullish assets? No. You need to select assets in harmony with the trend. Okay? Then select assets with a cause that equals or exceeds the minimum objective. What do you mean? What is a cause? A cause is a range, right? So what do you need to do? You need to examine the asset, and you need to ask yourself, is the accumulation phase over? Is it going to go up? Or if you are in a bear market, you need to go over the chart and see, okay, this is the distribution phase. We had a buying climax. We had automatic reaction. We had uptrust after distribution. Now we are below the range low. Now I can get in, okay? Because the cause, I saw the cause, I know that there was a range, so I know I can say that the market maker is now going to take this asset down, and I'm going to ride it with the market maker, okay? Now determine the asset's readiness to move. What do I mean? You need to see, is this, because in every market there are assets that move immediately. For example, we had Quant, we had Matic, Optimism. They were outstanding. But Link took its time, okay? Link took its time. So you need to be aware of that, and you need to get in when the asset is ready to move, because you don't want to stay in a position with an asset that simply does nothing. It simply costs you funding fees, or even if it's not causing you funding fees, it's an opportunity cost. You need to get in on the action at the right time. When is the right time? in an accumulation range, it's either at the range low or after the breakout from the range high. And the same applies to distribution. When do you want to short? You want to short either the uptrust after distribution, the top, the exact top, but not everyone can do it and it's dangerous. The safest place is after the range low was retested as resistance. This is when you go in, okay? And time your commitment with a turn in the market trend. Put your stop loss in place and relax, because if you have a good entry, you can just chill. This is why I like good entries, because if you have a good entry, you don't need to stress. Everything will work out fine. Okay, now about the citations. Don't hang up on me, please. Okay, because if you're interested in the Wyckoff methodology, I would like to recommend two books. These books are the best, really the best. The first is a book that it is called The Three Skills of Top Trading. When I prepared your PDF, I leaned heavily on this book. It's an excellent book. And if you are a professional trader and not an amateur, you need to read a few books in your life. Because you need to study. It's your profession, it's your job. So if it's your job, you need to be professional. The Three Skills of Top Trading. If you, maybe it's a bit expensive, this book, and maybe you don't want to get in depth, in that case, the Wyckoff methodology in depth. It is written by a trader called Ruben Villahermosa. The Wyckoff methodology in depth. It's a relatively simple book. The only issue I have with this book is that it needs an editor, terrible editing, but the information is first class and it is relatively simple. So guys, by all means, get yourself one of these books and go over it. And as always, I am looking forward to your comments, to your questions, and I thank you very much for giving me the opportunity to offload some of the baggage that I have in my head, because sometimes I feel that I have so much inside that it hurts. It helps me, it relieves me to offload some of it on other people, and I'm grateful to you. That's all I have for you on the Wyckoff methodology. Go over the PDF, go over the video a few times, and we will follow with a practical charting session. I will take you from the bull market high to the bear market low, and you will see the difference between real life and theory, because in theory everything is simple. In real life it's not always so simple. For example, here I'm referring to the period of September, October 2021 until November of 2021. What we had here is a Wyckoff distribution pattern. However, it was a very difficult pattern. It wasn't an easy pattern to recognize. But we had some clues. What were the clues? First, initial move, almost vertical. What is this chart pattern? Remind me, I think it's an ascending wedge, right? I'm talking to myself, but I know that someone will watch this video. After the buying climax, you can see the buying climax here, heavy selling. Okay, you can see the RSI, I think there were divergences. You need to check the volume to see if the rise in price was on diminishing volume. We have an automatic reaction here. Automatic reaction followed by a move to the upside, didn't even make it to the previous high, didn't even make it to the range high. This is a warning signal. You need to wake up when you see this. All the bells should ring in your head. But maybe you didn't understand it yet. Then you must understand it now. What happened here? Look here. What is this? It's called a sign of weakness. Why? Because price is so weak that it couldn't hold the range low. It dropped below the range low. By now, you should understand that the party is over. But, okay, maybe you didn't understand. Continue. What did we have here? Uptrust after distribution. It was short and it was brutal. It was executed by the market maker in perfect. Why? It didn't give you time to react. He pulled price once above the range in an uptrust after distribution and immediately took the price down. It was amazing, 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 but very ruthless. Secondary test, drop, tries to get back above the range again, drop, okay, last point of supply, and mark down, and price is going down, going down, going down, going down, until a preliminary support. What happened here? The downtrend is arrested a little bit. At what price? 39K. Dead cat bounce and the panic sets over the market. Now everyone understands that that's it, it's over. And heavy selling, which reaches a climax at what price? 33K. How long? 2 months after the initial downtrend. Selling climax, followed by an automatic rally, secondary test, uptrust, sign of strength. People begin to appear to be optimistic. Uptrust after distribution above 45 to 48K. The market maker is holding price. Why is he holding the price above here? Because he's building short positions. You need to recognize that. Look at these candlesticks. Okay? What do you see? You see short bodies and long wicks. You need to understand that what happens here, the market maker is building shorts and is getting ready to push the price down again. Preliminary support, last attempt. Here you should have already understood that that's it, it's over. And another move to the downside. This is Bitcoin. An example is AVAX. I don't trade AVAX. I wasn't on the lookout for AVAX, but on September, my friend John asked me to go over AVAX and to tell him what I think. And immediately I saw it at the beginning. When I saw it in September, it looked like a parallel channel. I was thinking along the lines of a parallel channel, not along the lines of a wedge. You can see the video on the channel. But immediately, what did I see? You see heavy selling, strong selling. What does it suggest? Selling climax. After that, automatic rally. And sign of weakness, uptrust, uptrust, continue, another uptrust, continues to go down. I called it a spring because you can see it didn't go below the range. But look here, 1, 2, 3, 4, 5, 6, 7. So many red wicks, but short bodies, almost no price action, which means that everyone forgot about this coin. So this was a spring and a jump across the creek, a move above. It's not a range, but above resistance, and the markup phase is beautiful. Just look at this coin, beautiful. And I said it on the video, you can watch that this coin has a very professional market maker. And if this coin has a professional, good market maker, you know that it's going to perform well in the future. So AVAX. Another example is DYDX. DYDX also very easy to identify accumulation schematic. You can see it's so simple. And you just need to know that there is such a thing called the Wyckoff accumulation. Why? Heavy selling with support, selling climax, automatic rally, range, uptrust, secondary test, uptrust. Where did this uptrust go? Look here, into the supply zone. Why? To test if there are sellers at this level, and there were. So again, secondary test. What happens here in the secondary test? Oh, price is not going as low as it did previously. Why? Sign of strength. Because traders begin to recognize the pattern and they want to say, okay, Mr. Market Maker, you are not by yourself. We are with you on this ride. And breakout above the range, jump across the creek. What happened here? They pumped the price to 435 when immediately before a huge unlock of supply. And once this supply was unlocked, prices came back to the range high. It's called back across the ice. Okay, there is a possibility in a Wyckoff accumulation pattern for price to drop back below the range low, and DYDX is not doing much right now, but with such a market maker, this coin will most probably fare very well in the future. Another example, DYDX. Okay, one more example from relatively recent Bitcoin. Okay, this is a reaccumulation pattern from December of 2023 until February of 2024. Why? Let's go over it. What do we have here? Buying climax, right? What happens after buying climax? Automatic reaction. Secondary test of the range low. Is the range low holding? Yes, it's holding. Is the range high holding? It's holding as well. Uptrust. To check, to check if there is selling pressure. Is there a selling pressure? Yes. Okay, so what do? You take the price down. Take oversupply. After that, one more uptrust to 49. Okay? Here you trap the longs. How do you trap the longs? Because you hold the price above the range high. The range high was at 45K. Price is holding, but look at the price action. Look at the price action. Short bodies, long wicks mean trouble. What happened? One more push up to kick every early short out of his trade and take the price down. Where to? To the range low. And what is this? This, gentlemen, is a spring action. Why? Because the purpose of this move was to make everyone think that price is going to 33K, to 30K, to 20K, whatever, okay? And what did the spring action do? Initiated a trend within the range, followed by a breakout. And we are currently consolidating below resistance What will happen next, I don't know, but maybe we will come back to test this range high again. I don't know if it will happen, but it's a possibility. So this is definitely not a distribution range. This is an accumulation range. And now that you know that, no one will fool you. Why? Because you took the time to study your craft. That's all I have for you on practical charting. If you have any more questions or anything else that I can do